So it is that time again. The Bank of England's Monetary Policy Committee have met to share what is happening with the base rate, which affects our mortgages, our savings, and so much more. What I'm going to tell you about is what's happened in this latest update and what they think is going to happen to inflation, which is the whole reason why these base rates have been so high for so long, and the base rate over the coming months and years, and a few things what you might need to be thinking about when it comes to your savings and borrowing as well. So first of all, what has happened? Well, for those of you who have been following this, it shouldn't come as a surprise. The base rate has stayed where it is, 5.25%. It's been here since August last year, and the Bank of England meet every 6 weeks. There's been 6 meetings since that last increase 9 months ago where nothing has happened at all, staying exactly where we are. Now, for some people, that's going to be a big disappointment. There had been lots of kind of rumours at the start of this year, lots of predictions that we would have seen a hike 6 weeks ago in March and maybe now, but as the year has gone on and inflation has proved to be what they call stickier, so not falling quite as they expected, those things haven't happened. It was very clear coming into this one that it was incredibly unlikely that we would see a cut at this particular meeting, and that is absolutely what came through. What was interesting though, there were 9 people on that Monetary Policy Committee, and this time, for the first time in a long time, 2 people out of that 9 said they wanted it to cut this month. So the majority, those 7, they're still saying, let's stick where we are, let's see how things are going. But there's an extra person joining that solitary voice for such a long time now saying there should be cut. So that signals some momentum, some movement of people going, okay, more and more people coming over to that side of it will be getting soon time to make those cuts. So what else? There's a big document attached to this particular minutes this time, which went through some of their predictions of inflation and the base rate. So I'll share those with you now before we get into what it might mean for your money right now. So in terms of inflation, remember, this is the big reason to say why the base rate went up so much, because having higher interest rates means that people put more money into savings, or their costs get more expensive, particularly if they have a mortgage, so they have less disposable income. So both those things mean there's less money to spend, and there's less money to spend, retailers will have to try and potentially lower or reduce how much prices are increasing to kind of encourage us back in to spend that cash. Because if everything's really expensive, we're better off in savings, or we don't have the money to afford it, well, things stay where they are. So this is kind of why we had all those increases and why it stayed where they are, because the inflation rate was double digits just not too long ago now, relatively recently, a year ago, end of last year, coming down, coming at 3.2%. They're the most recent figures we've got. And in this report, the prediction is that we will get to 2%, and 2% is the target. That's what the Bank of England want it to be, because that would suggest that prices are still increasing, because you still want prices to come up, to increase as time goes by, otherwise there's stagnation. So prices still going up, but they're not going up too much. 2% is seen as that kind of manageable rate. Target of 2% should be achieved. Mission accomplished, right? In just a few months, this time this summer. However, it's then going to go up again. So we'll get to 2% and go up to around 2.5% by the end of this year and into next year. Then, after that, it's looking like inflation will, let me get those figures up for you. It's looking like inflation will start falling again. So in the end of 2020, well, this time 2 years actually, say down to 1.9%, and in 3 years down to 1.6%. Again, these are predictions. Predictions have been shared in previous meetings from the Bank of England and elsewhere, and they have been varied quite differently. But this is where we're looking at right now. So inflation's still on target to be falling. They're still expected to happen and expected to get down, over the years to be still there and thereabouts, that 2% rate before, a bit above it, a bit below it, but still something which is, better for the economy than where we had those incredibly high rates previously. That means they're still looking incredibly likely that we will see some base rate cuts happening this year. Now, the bank say that from there, again, this is just predictions on what the markets are saying, and I'm sure this will change again, as they always change. I tell you guys, you take all this with a pinch of salt. It changes all the time. But they're currently looking like going to maybe 4.5% in a year's time, 4% in 2 years' time, and 3.7% in 3 years' time. So this is slightly higher rates for longer than what was talked about last time we had one of these predictions in February. So yes, anticipating that if inflation does fall as expected, then the base rates will happen, and they will happen potentially in that way. Again, we're talking so far in advance there that this is going to be different, right? It's not actually going to happen, but it does help us think about where we're going to do, and it does inform what's happening with savings rates and mortgage rates and things like that. Now, that's obviously looking quite far in the future. The current thinking, again, this will change drastically before the next meeting we have in 6 weeks' time. But the next one is that the first cut that we see is likely to be in the August or September meeting, but potentially it could be in the next one in June. There's still a chance we could see a cut in June, particularly because there are other figures that come along before then. There's going to be two lots of inflation figures. There's going to be sort of wage growth figures, all these things. So there is still a chance we'll see that first cut to 5% in 6 weeks' time, but more likely you're looking at 12 weeks or 18 weeks before we see that first cut. And hopefully then we'd also see another cut, if not two cuts, by the end of the year. But again, that prediction is gradual cuts and still saying 4 to 4.5, 5 to 5% over the sort of the next sort of year or so, if not more, like 2 years, which again is slower, fewer cuts at a slower rate for longer than we were talking about, just a few months ago. So that's what we're looking at right now. That's where kind of the current predictions are. I say it could all completely change, but it's worth sharing with you because it does inform what we're thinking about when it comes to other things. And mortgages, first of all, quickly touch on that. As I tell you guys all the time, if you want to fix, it doesn't make a difference to you right now. Your prices won't change. And if you're on a variable rate, your prices won't change either because nothing has changed. They can change them if they want to. And if you're on a tracker rate, they definitely won't change. So no change right now. But there are still, all the time, so many people coming off those fixed rate mortgages, which were probably fixed 2, 3, 5 years ago at much, much, much lower rates. When they come off those, they're going to come onto those really, really expensive rates. And we have seen, because of these kind of this prediction that we'll see fewer cuts and later cuts to the base rate this year, we've actually seen mortgage rates, after they sort of falling slightly, starting to come up again from lots of providers. So that's really going to be frustrating for so many of you coming out of this. I guess the best thing you can do, and it's the same thing I say every 6 weeks, right? Because it's the right thing to say, is to talk to a mortgage broker, and they will be able to give you their qualified expert advice on the product you should be looking for and the situation you're in and what you should be doing. Should you be going for a medium to longer term fix than you normally would? Because if we're looking at rates not falling too much in 2-3 years, then maybe there's no point. Those longer fixes are cheaper. You get them at a cheaper rate than maybe a shorter one now, and then in 2 years' time having to get another one. They're the kind of people who can tell you exactly what to do for your situation. And don't forget as well, if you are concerned about locking in to a mortgage rate now, whether that's remortgaging or a product switch with your actual existing mortgage provider, most of them, just double check this when you get the deal, most of them will let you exit to agree a deal 3 to 6 months in advance. And as long as they allow you this, you can exit if a better deal has come along nearer the time. So again, talk to a mortgage broker and work through all your options. Now, when it comes to savings, this latest freeze isn't going to have too much of a difference to you because, again, we've already priced in these cuts are coming. So we've already seen over the last 5-6 months, all those fixed rates falling. And over the last 2 or 3 months, there's easy access rates falling as well because they're anticipating this is going to happen. So they're pricing it in, already giving you slightly lower rates. Now, the fact that the cuts aren't going to be happening maybe as quickly or as fast as expected could mean you see a little bit of a increase to some of those shorter fixes. And we have seen 6-month fixes, 9-month fixes push up a little bit at the top of the table. But everyone else, they're still coming down. And any kind of competition that comes along, that's the only thing. If someone's like, we need to get some money in, so we want to go top of the Best Buy tables, don't forget, be clever with your cash.com/savings is the place to go. Where myself and the team, every day, we're updating those tables. Maybe they'll push up and someone else pushes it up a little bit, but we're not going to see any of those kind of really, really big hikes because really, really doesn't look, not impossible, but really doesn't look like we're going to see any increases to the base rate and let alone staying at this level for much longer. So I would say if you have got any savings, which you can lock away, said this last time, said it time before, it does make sense to get one of those fixed rate accounts to guarantee you're going to get a decent rate. Now, if base rate doesn't move as quickly as expected and it doesn't drop as far as expected over the coming years, it still would suggest that, it's not going to go too much lower. You could still be able to get a fix of, for 2-3 years above 4%, which is great. But again, you never quite know. And yes, there is the risk if you fix now that rates can go up and you miss out on a slightly better rate. But I think that's better than the risk of you not fixing and then rates do come down. And don't forget, we are going to see actually when it comes to easy access, Santander cut their very popular 5.2% paying account in just a few weeks' time, on the 20th of May, from from 5.2 to 4.2. Now, this is close to existing customers anyway, but so many people signed up to it. It was incredibly popular because it was a big rate with a big bank. That will also fall, and then I'm sure we'll see other cuts coming along as well. I'll update you those whenever I can. My name's Andy Webb. Thank you so much for watching. Check out these videos here for more ways to make the most of your money.